Hello, my name is Joshua Morrison, an investment analyst here at True Potential. Today I'm going to touch upon two key stories that emanated in the headlines this week relating to the US interest rates and Eurozone economic growth. Primarily, the Federal Reserve, or Fed, this being the US's central bank, announced on Wednesday that they would continue to pause on further interest rate rises. This came as a surprise to many investors who saw the better than expected US GDP growth as a possible catalyst for the Fed to continue their rate increases. Instead, the central bank quoted sluggish inflation levels as their main rationale for a continued halt. Moving away from the US and focusing on Europe, the latest data stemming from the Eurozone suggests the economy picked up at the start of the year. Now, the Eurozone, not to be mistaken by the European Union, represents 19 of the 28 countries that constitute the EU, all of whom have adopted the euro as their sole legal tender. This market obtained an accelerated growth rate of 0.4% in Q1, beating analyst expectations and reversing the sharp slowdown experienced in the second half of 2018. Since December 2015, the Fed raised interest rates by 9 0.25% increments, the last three particularly hampering US stock market performance. You may ask yourself why interest rates have such an influential role in the state of the economy. Simply put, they indirectly impact growth and prices within said economy. This is done by directly impacting the cost of financing both consumption and production through an increased cost of credit, whilst also enticing consumers to save rather than spend. Therefore, with deviations in the current rate of interest so influential, the fact that the Fed have decided to maintain current levels should give investors and markets reassurance that we shouldn't expect any significant fluctuations in market performance in the near term. In reference to the Eurozone, a key factor associated for its turbulent 2018 performance was country-specific issues that major contributors experienced. These include Germany, France, Italy and Spain. As we head further through 2019, each of these economies are experiencing rebounds in both their economic performance and underlying fundamentals. These include increases in manufacturing output, household consumption and retail sales. However, perhaps the most significant fundamental is the region's decade-low unemployment figures, which were reported at 7.7%. Overall, with sentiment improving, we may see greater inflows of investment into this region as its recovery continues. Whilst the Fed maintain their current position, many others are questioning whether the US may in fact need an interest rate reduction to spur low inflation levels. None so vocal as President Trump, however, the Fed must walk a very fine line. If they openly discuss rate reductions, then they run the risk of signalling that the economy is weak and thus spooking investors. Despite increasing criticism, the Fed have maintained their patient stance, arguing that with a strong job market and continued growth, inflation should return to their 2% target. Overall, the amalgam of these factors does paint the picture that the Eurozone has moved away from its darker days and is on the road to recovery. However, the European Central Bank, or ECB, have cautioned that with external uncertainties such as Brexit and trade disputes still lingering, there needs to be a greater degree of clarity within the underlying story before stronger growth figures are cemented as a sign of overall economic recovery. Ultimately, it appears that the story of continued economic success still resounds as we head toward the second half of 2019. Subscribe to our YouTube channel to ensure that you don't miss out on any future weekly updates. Thank you for watching.